10th of February. Let's get the show started. You're watching Business Morning live here on Channels Television, Nigeria's news leader. I am boasting the global markets jitters over coronavirus enters new week with the oil prices still in the red territory. Nigeria's benchmark crude Brent is 54.32 per barrel at about 6 o'clock Nigerian time. Stock market still negative around Asia and the European markets today, but gold is still going green. Meantime, China says it's pumping $10 billion into the coronavirus outbreak with a special funding for about 9 selected banks to keep the country's business sector going. Back here at home, the 3-day International Petroleum Summit begins today in Abuja, Nigeria's political capital, for principal decision makers from public and private sector to exchange innovative ideas. There are 3 key areas of focus if you're tracking this 3-day event, which holds annually here: the launch of the National Gas Transportation Network Code, the ministerial session on policies, investments, and technology, as well as the Governors Forum on what to expect from oil-bearing subnationals. Meantime, Nigeria's NNPC, that's the State Oil Corporation, reported that the vandalization of its network of pipelines increases by a whopping 94% in November last year. That means a total of 68 pipelines were vandalized in the month of November against 35 in the month of October. Take it all down to the market street, where Sky Shelter Fund, listed on the stock exchange, has informed the market of the name change to SFS Real Estate Investment Trust. The trading symbol of the company has also been changed from Sky Shelter to SFS REIT at the stock exchange. Meantime, the insurance sector is heading towards the recapitalization by December this year. Meantime, listed ICO Insurance PLC is planning a special meeting on March the 5th to approve 3.5 billion rights offering to shareholders. The company is looking to meet the new higher regulatory capital of 18 billion for composite insurers. ICO recently completed a private placement of 4.4 billion shares, which was sold at 120 kobo, worth 5.280 billion naira. Let's check through quickly for you how we finished off on our market street last week. 2.69% decline in the Nigerian Stock Exchange all-share index for the week. We're standing at the doorsteps of 27,000, and the index reading 28,067 there for you. You can see that for the week it was 1.478 billion shares exchanged in about 23,263 transactions. If you flip that and you look at the 5 key sectors, investors booked profit very heavily on industrial goods, consumer goods, and the banking sector, as well as oil and gas. Insurance made about 0.2% in the green territory. A quick check into the oil and gas space. As you can see, 10% upside to the shares of Japol, a very small oil maritime company, services company there. On Friday, the share price 22 kobo. Investors traded 17.767 million shares. That's got a very big push for a single day. Eternal Oil was down 8.51%. Its latest earnings was largely negative, and Capital Oil was down 9.09 on the last trading day of the week. Check with me very quickly the unlisted securities market. That's your NESD. Over the counter, that's a bit 0.1% below the 700 NSI reading, but the market cap held it steady, 501.83 billion naira at the close of the market. And that's the total transactions there for the week we just finished, 2.47 million NESD shares. We'll talk about the bond and the treasuries market a little bit later when we do our crossover to FMDQ Exchange Place in downtown Lagos. But let's bring everyone up to speed. Some of the time we spent last week talking about the derivatives market and the new approach from the regulatory side and the market operators. Earlier in the week, the Nigerian Stock Exchange with the SEC held a market workshop for those who are interested to understand what new regulations are and the new threshold. And towards the end of the week, Meristem Securities, one of the investment bank and securities trading firm, held another workshop with the Nigerian Stock Exchange to get everyone to understand what new products are coming in the derivatives pipeline, or what you call the ETFs. The head of investment research at Meristem Securities, Ahmed Jinad, is here with us this morning to take us through some of the new developments around Nigeria's derivatives trading market. Thank you. It's good to have you.
Yes, thank you.
Hope you had a nice weekend.
I did, and you?
I think this is a good time. I'm okay. I'm battling the flu, but I'm trying to keep on keeping on. So let's drive the derivatives market. First, from the regulatory point of view, and I'm sure if you're floating new products in this pipeline, you'll be listening and looking at what the regulators want, the SEC on one side, and the platform on which you're trading it, this time the Nigerian Stock Exchange. What did you learn last week?
Basically, the introduction of the derivatives market has been long overdue. And what we saw last week was a confirmation that most of those issues, in terms of structures that need to be in place and regulatory frameworks that need to be in place for us to actually have a thriving derivatives market, have been largely sorted out. On the part of the SEC, the rules, we now have rules that will guide introduction and trading and other issues around the derivatives market in Nigeria. And then a very critical thing in times past has been registering and the introduction of a central counterparty clearing house, which is very, very key if you're going to trade derivatives on an exchange. You know, we already have them in the market, but they trade over the counter. But a central party that will help bridge the gap between the buyers and sellers of the derivative, which is the central counterparty, is what was always was not finalized before now, and that has been done now. So essentially, the gauntlet has been thrown from the part of the exchange and the regulators.
What does a central counterparty really do when you talk about derivatives, which is not the same as the underlying assets, in this case, whether it is stocks or gold or any other assets?
Okay, good. You know, I said we already have them trading over the counter, so
yes,
amongst dealers. So to trade derivatives on the exchange, that party essentially buys from the buyer of the derivatives, with the issuer of the derivatives, and then sells to the buyer of the derivatives. So that so at the end of each day, right? Okay, let me give you a more practical example. Say a forward. A forward is customized, it's not traded on the exchange. Say I'm a farmer and I'm trying to hedge against commodity price risks, for instance, and then
for cassava, for example.
Let's say for cassava, for instance, okay, I think that cassava will, the price will probably crash by the time my harvest is due. So I lock in a contract, because derivatives are essentially contracts. So I lock in a contract to say I'll sell a ton of cassava for, say, 1,000 naira at a particular price, called strike price, at a particular price, right? Because it's just both of us, so there's a counterparty risk in the sense that either party can default, actually. You can default, I can default. I could come around and give you stories about how there were low-cost infection and stuff. So
or flooding.
Or flooding, or whatever it is.
Or some thieves.
Or some thieves.
Or cows, whatever, cattle.
I mean, the list is endless. When you default, you make these excuses easily. But when it is traded on an exchange, the counterparty makes sure that you have an account where there's a minimum amount that you put into that account, so that at the end of each day, depending on the price movements, at the end of each day, the prices are marked to market. So someone takes a loss based on the price movement for that day, while the other party makes a gain. And if there's a difference, you get a call to up that balance. So that is a very essential
ingredient.
Yes, if you're going to have a derivative
so the ecosystem is not really complete until we have that counterparty that clears it up, because it's a derivatives market. It's all on paper, and because it's a forward contracts and not a T+1, T+3 transaction, say like you have in other assets, it makes it the risk are very high.
Even with those ones, I mean, look at we still have a central clearinghouse system where
where you do depository and all of that.
You understand. And so that is kind of like a similar role that the counterparty will play. And apart from that, it helps to make sure that even if you're going to default, because prices are marked to market on a daily basis, so you don't end up with a position that is too large. And then and this is also very important for the overall health of the derivatives market as well. When you have several positions that are very huge and then you now have people defaulting, you know what that does to confidence and the performance of the market. But because prices are marked to market on a daily basis, it means that you reduce the chance or the possibility that you have several large positions that could go bad.
So you market participants or market professionals are learning all this new curve. Are you confident of what the SEC is doing and what the Nigerian Stock Exchange is doing on their own part to come together to make sure that this new horizon of derivatives trading, whatever new will be coming through, whether you're doing it on the banking, oil and gas, whatever sectors that are coming through, existing in the market, and want to write derivatives or papers or ETFs on them, will go smoothly as everyone would want it?
Yes, definitely. In fact, if you were at the workshop last week, people were kind of like a bit scared with the tone from the
SEC. We had a bit of a playback on that
yeah,
here.
from the SEC. People were like, "Oh, this tone it's a lot aggressive," and rightly so. You know, it's more complicated product than anything we are used to
in this market.
In this market, and of course, a lot of investor education will be required so that people understand the risks and other intricacies that goes into the derivative, because there are so many possibilities now. Because, I mean, when you have a derivatives market, you know, essentially it is between different parties to structure the products, and it could, I mean, you could have several types of products coming into the market. So on the part of the regulators, what they want is that they want to be sure that parties understand the risks fully before, so that you're not just saying, oh, there's something new in the market, you just sell to everybody.
Who should go into derivatives in terms of participation? Well, I'm concerned about local retail investors. I know you institutional investors have your neck deep into it, so you understand how it works, globally speaking, so you can always learn best practices here. But again, I'm concerned about who should go into it. This is not plain vanilla.
So good. So, you know, it's not like the products, there's no blanket, how do I put it now? No blanket structure to say this is all the possibilities that you can have with derivatives product, because when you have this, there are different variants. So the idea would be to start with the less complicated. As people use it, I mean, see how it works, and then you can bring them up to the more complicated. Everyone is used to stocks. For instance, exchange-traded funds, a lot of retail investors have not really embraced that. So that's like a very good way to start. And of course, you know, we are bringing something to the market, I mean, already. I mean, so that is easier to understand. Let's start from less complicated products, and then we can, and of course, you know, because of what you use derivatives for in terms of managing risks and hedging your risks, so you can see maybe in that sense, excuse me, maybe in that sense, more suited for institutional participants than retail. But still, there are some products that can be pushed to retail with education, of course.
What does derivatives trading do to an emerging or frontier markets like ours?
So, it deepens the options. It deepens the market. I mean, right now, everything is equities. If you look across different portfolios, we are all basically holding the same kind of stocks in our portfolios. And then most importantly, in terms of attracting capital, foreign investors want to come into a market when they know that they can hedge their risks, mainly FX risks and maybe interest rate risks, depending on what the underlying
and for FX right now, we can see a bit of that since 2015. 2016 when with the FMDQ and all of that.
Yes, but even that is still kind of restricted because you have this. It's only the CBN that really
that intervenes. Yes, that intervenes in that market.
Intervenes in that market,
So
and then it is also not standardized. You know, I mean, it's over the counter. So you still have. It's not everybody that can pay, and it also has to be trade backed in the sense that, I mean, for you to get that kind of instrument, you should have an underlying trade. So that to say, and you know what they settle is the difference between what you enter at as the price when you decide to exit the contract. So it's the difference between that the CBN will then settle. So I mean, so when you compare that to what is possible when you list on an exchange, having standardized contracts,
it's a lot bigger.
It's a lot bigger. It's a lot bigger. And then most importantly, liquidity, which is very, very important. when you have instruments that are trading on the exchange that have several people holding it, it's very easy to get in and to get out. So, but on the whole, what having a thriving derivatives market for a market, an emerging market or a frontier market like Nigeria, what it does is that it makes it easy for a lot of players, both foreign and domestic, to play in that market. And then, it gives a lot of options to hedge against risks and all that. So.
What risks do you think are risks? There are certain risks that are peculiar to every derivatives market, but every jurisdiction has its own, a bit of its own peculiarities. So if you look at the Nigerian market, what risk are you market professionals thinking of or seeing already that could be there in the new derivatives market we're pursuing?
In my opinion, I think most of it will come in terms of, it depends on the product first. And I say that because, like I said, it's a contract. And once you enter into it, it's locked. And then, so if you are using it to mitigate your risk, for instance, I think there is little to expect in that case. It means that you've looked at your portfolio, you've decided on the level of risk that you can accept to lock in a price to say that, okay, I think I'm comfortable exiting this contract at this price, right? But if you are a speculator, because that's another thing that you can do in the derivatives market. If you're a speculator, of course, you face price risk. Or in the case of, say, it's an interest rate derivative now, of course, I mean, we don't have to go too much into that, given the trends from last year, the CBN policies and all, and how that has impacted rates.
I know what you're hinting at.
Yes, I'm hitting it.
If you do interest rate derivatives or whatever here, last year would have been highly volatile.
Very volatile.
Considering the whole unusual or unorthodox monetary policy.
And then how that has impacted rates in the market generally. So.
Well, that's what the market is all about, volatility, whatever it is. That's what it is.
Yes, that's what it is about. But in terms of, you can sit with your models, simulate all that, but you will not simulate the CBN segment.
No, you can't simulate central bank anywhere in the world.
You understand?
Sometimes
so you can't simulate the central bank, but you expect that, okay, the central bank gives guidance, and that's
forward guidance.
Forward guidance to signal to the market.
I got it.
This is where we are headed.
Give me some body language. If you want to put it that way. Yeah. So when we look at the still talking derivatives and all about the pipeline of products coming to the market, you folks at Meristem were part of the market last year or so with a small basket of indices that you listed. Then you want to add some ETFs into that. Talk to us about that, please.
Okay, so basically last year we launched our style indices, growth, collaboration with the NSA, of course.
Yes.
Both the growth index and then the value index. And right now what we are doing is building ETFs on those two indices. So the two ETFs that we're bringing into the market will be tracking those two indices. So we have a growth ETF and then we have a value ETF. And you know what's coming from the style indices, I mean, you are creating a portfolio of stocks based on a certain investment style, the growth to capture growth companies, and then the value to capture underpriced or undervalued stocks, as it were. So building an ETF on that now means that for investors, and this time around, we're even looking at a lot of retail. We're trying to attract retail investors in that now means that you can have an exposure to that investing style. It is new. I mean, it's nothing like...
So you're trying to capture the top end of the market and the low end of the market. So whichever way you want to play it, retail investors can play both sides. If you want to play stocks in the hundreds of naira and in terms of dividend or share price, whatever, and then you can do what you call technically penny stocks, as it were.
Yes.
So that's the target here.
Yeah.
So if you look at the composition of the growth index and the other index over the last 1 year, you think it is time to put an ETFs on them. What's your projections here on how this will go?
If you look at the historical performance of both indices, they've consistently outperformed the NSE 30 as well as the All-Share Index, and then you feel that on a cumulative return basis, the value index is doing 60% since 2015, and the growth index, I think it's doing 30-something%. I mean, you can imagine having an exposure to that. And then more importantly, it's a passive style of investing, unlike your mutual funds where you have the fund manager trading actively, trying to see what opportunities are abound in the market and taking advantage of that. This is based on a particular philosophy, that this is the kind of, I want stocks that are undervalued in my portfolio. And so instead of you doing all the analysis and trying to find out, okay, let me buy a little bit of this, a little bit of that, that has been done for you, and then you can then
just buy the
hold
basket.
Yes, exactly. And then you don't have the fund. It's not at the discretion of the fund. Of course, it gets rebalanced twice in a year, which considers big because we have certain factors to screen that.
Great.
So you just check that, okay, these stocks in this basket still retain those
quite a lot
features.
to learn, Ahmed Junaid. Quite a lot to learn in this new horizon. Thank you so much for coming. We appreciate that. Head of Investment Research at Meristem Securities and Investment Bank and a registered securities trading firm. Talking about derivatives. When we come back, we're checking into earnings box as we start a brand new week.